Hello people, very good to all of you. So guys, we started with a brand new topic in the last class, which is company accounts. And in that, the first chapter that we're going to see is accounting for share capital. So guys, in India, we can do business in multiple forms. The first form being the sole proprietorship concern. Now this, has certain inherent limitation because of which people look up to doing a partnership business. Again, partnership business is suffering with certain inherent limitation because of which people look up to LLP. So the primary difference between the normal partnership and the LLP is that it is coming with regard to the liability clause. So in the partnership concern, the liability is unlimited, which means what? If the organization's asset is not sufficient to pay the liabilities of the organizations, then these liability holders can attack the private assets of the partners. Whereas in LLP, they cannot do that. If the liability of the business is not settled by the assets of the business, the liability holders cannot attack the assets of the partnership concern, except in the case of lifting up of corporate veil. So this concept of lifting up of corporate veil is something you'll study in your higher grades or any professional courses like CA, CS, CMA, MBA, etc. Now again, these partnership concern suffered with the inherent limitation because of which people looked up to company. So here majorly 2 points. One is liability. Of course, sole proprietorship and normal partnership again suffers with unlimited liability. So people look up to companies form of organizations to have a limited liability, to have the limited liability. So one is that benefit. Second comes with respect to the capital, right? Before capital, I would say that the restrictions in the sole proprietorship concern is we can have only one owner. In the partnership, the maximum owners or partners that you can have is 50. So if we want to do a business, where it requires more than 50 owners, then the partnership was not allowing. So to break that limitation, people look up to companies, right? So that is how the concept of company we started studying. So guys, company is basically an association of people where people come together for the purpose of doing the business. Now this company is got certain, characteristics or features, which the first one being it is to be incorporated, which means for a company to be created, it has to be registered. So registered with whom? Can you please tell me? Government. So government here is who? ROC. Register of companies. So we have to file the application to register of companies. So we'll be discussing about the registration process in the next class. So we have to do it with ROC. ROC is basically being governed by MCA, the Ministry of Corporate Affairs. So here in the companies, the registration with the law is compulsory. Whereas for partnership, there is no concept of registration. That they said that have a agreement. Written or oral is your choice, but agreement should be there. Registration was not compulsory in partnership. Whereas in companies, registration is mandatory. For a sole proprietorship concern, there is no concept of registration. Even without registration, you can one fine day get up in the morning and start the business. Nobody will question it. But company, you cannot start like that. You need to go through a process. The process begins with the registration. Point number one, right? So registration is very important. When you complete doing your registration, you become a legal person, right? So you have a legal person having a separate legal entity. You have a separate legal entity. So here the company is different and their owners are different, right? The owners here are called as shareholders or they are called as members. After registering of the company is called as an artificial person. So who is giving the status? The law is giving the status that company now officially you are an artificial person. So by being called an artificial person, what is the benefit for the company? The benefit is that the company can own the property in its own name. They can enter into contract. The company can enter into contract with the human being or let's suppose any other artificial person. They can do the business by themselves in their name. So business can be done in their name. They can sue or be sued. The case can be filed in the name of company or company can file the case against somebody else, right? So this is the third feature. Fourth feature is perpetual succession. Perpetual succession means what? The death of a member, that is the death of a shareholder or the bankruptcy of the shareholder or the lunatic behavior of the shareholder will not affect the going concern of the company. Because we learned in the very clearly in the last class, the person who is managing the business is different from the person who is investing in the business. The shareholders are different and the management is different. So who is managing the business? Management is managing the business. So shareholder, whether he's bankrupt, whether he's lunatic, whether he's died, whatever happens to him, how does this affect the company? Because company is run by the management. If management is suffering with any of these problems, they'll change the next management. You're getting my point? So by that way, company will keep on going forever. So here the standard saying is that member may come and go, but the company will go on forever. This is a standard dialogue. Members may come and go, but the companies will go on forever. That is the concept of perpetual existence, or you can say perpetual succession. Another name for this is, you can note it down, this is perpetual succession. If management, something happens, succession, I'll just write the spelling properly. SUCCESSION. Perpetual succession means that if something happens to management, if somebody dies, the core management person dies, immediately there'll be a backup. So it will keep on going on ever. So somebody will come and succeed the business. So perpetual means forever, continuously. Succession means the succession will be forever. Next is limited liability concept. I'll be discussing about this in detail. Though I've discussed in short in the previous class, I'll be discussing about this in detail in the upcoming class. Then comes the transferability of the shares. So before we talk about shares, guys, what do we understand by the share? So basically, in the sole proprietorship business, there is one person who is contributing the capital. He's called as a sole owner. In partnership business, there are multiple partners contributing the capital. So they are called as partners, and the capital is called as partners capital. Here in company, we give a fancy name. We call it as a share capital. The partners capital, what we individually call it in the partnership concern, or the total capital, what we call it in the partnership concern. Here, the term that is being given is share capital. Why the name is share capital? Because the capital is being shared by multiple people. So share capital is the total capital of the entire company, which is being shared by multiple people. So how much ever shares you want, how much ever percentage of profits you want, that much number of shares you can buy. So here share represents what? Share represents share of profit. What else? We discussed two things. Share represents two things in the last class. Share represents share of profit. What is another thing? Share of capital. So share here represents two things. One is share of profit. So you want this much capital in the business, you give that much money and take the share. So to that extent, you become the owner of the company. To that extent, you can reap the profit in the future. So out of 100% of capital, if you're wanting 10% of profit, then to the extent of 10% of capital, you have to invest the money in the business. So how much money you have, how much ever you're willing to invest in the business, that much money you invest, and proportionately that much share you take it. So that is called as shares. Now, when you pay the money and you become the shareholder of the company, there has to be an official document which says that you are the shareholder now. So there'll be a certificate that they'll be giving. That is called as a share certificate. In the share certificate, they'll mention how much money you paid. In return, how much shares you're getting. Right? So all the information will be covering in that particular certificate, which will make you entitled, which will give you the entitlement for becoming the owner of that particular company. Am I clear with this point? So are you clear with the meaning of share capital? The person who is investing the money in the business, who is contributing the capital, is called as a shareholder. The shareholder, in other words, is called as a member. Am I clear with this point? Cool. So transferability of the shares. Now you've taken shares of some company, right? Now you no longer want to be a part of that company. So what can you do? You can transfer it. So transferring of shares is possible in the listed company. So we'll be discussing about that. Public company, basically. I'll be discussing about kinds of company very shortly. So if you're a public company, and that too if you're listed where? Listed on the stock exchange. In that case, you can freely transfer. Shares of a company are freely transferable in case of a company listed on the stock exchange. With the click of a button, I told you, people trade in the share market. With the click of a button, they buy and sell. That is called as transferability. That is very easy. But if a public company is unlisted, here we are talking about listed on stock exchange. Unlisted company means what? They are public company, but they are not listed anywhere in the stock exchange, which means what? Their shares cannot be that easily traded in the stock market. So in that case, what you have to do? You have to follow the manual procedure to transfer. So manual procedure will take a lot of time. And for that to follow, you have to follow the rules and regulations laid down in the Articles of Association. What is Articles of Association? It is basically the rule book that the company is supposed to follow for their internal management. Are you able to follow? I'm going this fast because we've already covered this topic in detail in the previous session. I'm doing a quick recap because there is a gap in between. So to fill that gap, I'm doing a quick revision. So I hope you're able to match with my pace. So we spoke about public company, listed company, unlisted company. Now coming to the private company. Private companies shares are not that easily transferable. Again, for them, if articles of association permits to transfer, you can transfer. Otherwise, you cannot transfer it. If at all AOA permits to transfer, the procedure is very complicated. It is not that easy as it is for the listed public company, right? So this is the transferability of the share. Second, we agreed that management of the business, that is company, is different from the ownership of the company. The person who is managing the business is a different person, and the person who is owner is a different person. Only few people can be common. For example, the managing director. For example, in the case of Reliance Limited, Sir Mukesh Ambani is the managing director, who is a management person, also is a shareholder. So few cases there will be an overlap between the management and ownership. Otherwise, management is separate, ownership is separate. So for example, if I have the Reliance Limited share, so I am the owner of that company. I'm a part owner of the company. Even if I have one share also, guys, I'm the owner of that company. But can I go and participate in the management of that business? No. Because management is done by the people whom we elect, or the management elect. The top management may elect the bottom management. Are you able to follow? Next is common seal. Common seal is basically the signature of the company. So if company can enter into contract, we agreed now. If company is entering into a contract, then company has to sign. But can company sign? Does company have hands? Not possible. So that has been represented. Company signature has been represented in form of a seal. So the company, wherever is signing into a contract, wherever they are entering into any form of contract, any document for that matter, they have to have a seal of the company on that particular document. Am I clear or not clear? I think till this we have studied the last class. Okay. Now guys, difference between partnership and the company. Partnership, mode of formation. How is partnership formed? It is set up by an agreement. Agreement is mandatory, whether oral or written. It is up to you. If you have oral, then you might have a problem. That is your headache. But oral is allowed. Advised is what? Having the partnership agreement in written is advised. And the written partnership agreement is called as a partnership deed. It is set up by an agreement among the partners. Registration is not compulsory under the Indian Partnership Act 1932. Please take a highlighter, highlight this point. Registration is not mandatory for partnership concern. Company, it is set up by registration under the Companies Act 2013. So now partnership is governed by Indian Partnership Act 1932. Partnership firm is governed by the rules and regulations that you would look up to is Indian Partnership Act 1932. Whereas the company will look up to which rule? Companies Act 2013 rule, or any previous company act where they have registered under. For example, Companies Act 1956. Here for them the registration is compulsory. For company to be created, registration is compulsory. If this point is clear, I'll go forward. What is the applicable act? Regulatory act. For partnership concern, the regulatory act is Indian Partnership Act 1932. For company, it is Companies Act 2013 applies. So today guys, every company, whether you are registered under this act, whether you are registered under previous act, everybody will follow the rules and regulations which is given in 13 only, because this is the latest rule. Traffic rule, imagine 100 years ago, they were different now. That time the vehicles were different, bullock carts were there, everything was different. Can we still follow the same rule today? Today, things have changed very drastically. Modern vehicles have come. That rule is not applicable. So today, what will you follow? The latest rule. Even though the vehicle is registered under the previous act, still the rule that has been followed is the latest rule. Same applies for this also. Am I clear with this point? Next, number of members. Very, very important point. Full 100% attention. For partnership, minimum is how much? Minimum 2. Online people, even you can respond. Minimum is how much?
2,
Maximum is how much?
50.
50.
So 100 is there. But today, government has exercised the power that maximum limit that will fix is 50. If government wants to increase, they can increase up to 100. But today the government has said that the maximum limit will be 50. Means 50. So minimum 2, maximum is 50. Correct? Now, listen to me very carefully. In the case of public company, what is public company? We'll be discussing in the next slide. In case of public company means what? In that company, public are contributing the money. Minimum number of members is 7. Minimum number is 7. Without any maximum limit. So for a public company, minimum is 7. Maximum is unlimited. Any problem? Public limited company. Minimum is 7. Maximum is Unlimited. Private company must have at least 2 members. So what is minimum? 2. But not more than 200, which means what maximum? 200. Important point here is excluding its present or past employee member. At this point, you have to wait at least for half an hour to understand, because when I come to the private company, I'll be explaining this part here. B point. When I come to this B point, I'll be explaining in detail. So as of now, you have to keep it little bit in suspense. So private company minimum is how much? Private minimum to maximum 200. But this 200 is got a star mark. Do you understand what is star mark? Terms and conditions applied. Clear? Then finally, 1% company has only 1 member. So there's one more company called as OPC. Here, minimum 1, maximum 1. Any difficulty? So let's repeat one more time. If I talk about company, guys, please tell me. For public company, minimum is how much? I want everybody to participate loudly. Online people, even you also. Minimum is how much?
7, sir.
Maximum?
7.
Unlimited.
No limit.
Very good. Private, minimum?
2, sir.
Maximum? 200.
200.
Terms and condition. OPC minimum?
1.
Maximum?
1, sir.
Now this number what we saw is for what? Member, shareholder. Be very careful, because you'll have a similar minimum and maximum limit for director also. So people get confused there. So member, we're talking, this rule is for members. So please be very, very careful. We're talking about the shareholders. We're talking about the owners now. If this is
Sir,
clear.
I have a doubt, sir.
Yes, boss.
Sir, you told that shareholder means owner, sir. Then in 1-person company, if there is only one shareholder, then what is the difference between that and sole proprietorship?
So your question will be answered probably in the next slide. When I start discussing about OPC, right? I'll be discussing that point.
Okay, sir.
Now, coming to liability. Very simple, guys. Liability of a partner is unlimited and they are jointly and severally liable. If you remember, I made you write this particular point when we are doing partnership, especially when we were doing dissolution. I told you if the question comes, what is the liability of a partner in a partnership concern? I told you to note down 2 points. One, the liability of the partner is unlimited. Point number 1. And all the partners are jointly and severally liable. These 2 points are very, very important from the MCQ point of view or accession based questions or from theoretical point of view. Please take a highlighter and highlight this point. Very, very important. I repeat one more time, guys. Listen to me very carefully. If they ask you the question, what is the liability of a partner in a partnership concern? You will give 2 points. One is liability of the partners in a partnership concern is unlimited. Point number 1. Second, all the partners are jointly and severally liable for their acts. These 2 points is 100% to be written cumulatively. Now coming to this point, I'll be discussing this separately, because after I discuss the kinds of companies, we have an exclusive discussion on the liability. So I will not waste the time here now. In fact, I would have been happy had they given this difference between at the end. So by the time we would have discussed all the concepts and then come back and we would have done the difference. But since we have started, we can just continue, not a problem. Distribution of profit. Profits are distributed as per the terms of partnership deed. In the partnership deed, you would have agreed the profit sharing ratio. So you'll distribute the profits accordingly. If not, it will be equally. If PD does not exist, equally. Here, guys, here, I told you very clearly. Here, the profit word is not used. Here, we use the word dividend. The board of directors. So there are multiple directors in the company. So all these people, have the authority to sit and discuss and make some decisions. So all these people put together are called as board of directors. I told you in company, we are fond of using fancy names. So here they call it as board of directors. So board of directors is a group of directors who takes the decision on or for the company, on behalf of the company or for the company. So board of directors takes a decision how much dividend is to be paid. Here we don't use the word profit. In partnership, distribution of profit is called as profit distribution. Whereas here, we don't use the word distribution of profit. Here, the word is distribution of dividend. So who is deciding how much dividend is to be paid? Board of directors will decide. Then you may question, sir, if everything board of directors are deciding, then as a shareholder, the person who is contributing the capital, what will he decide? In this case alone, Board of directors will decide how much dividend is to be paid. That is called as proposal. That is called as proposal. It's not that proposal. I'm talking about education proposal. But it has been finally to be approved by shareholders. So what happens is that board of directors will propose that let's give rupees 10 per share as dividend. This is the proposal. Who proposes it? Board of directors. Like boys propose, no? Like that board of directors proposes. Does it mean the acceptance? Somebody has to accept, no? On the other side, there will be somebody waiting and telling that accepted, not accepted. Same way here, who's on the other side? Shareholders. So shareholders will say that accepted, not accepted. So shareholders have three options. One, they can accept this as it is. Take the rows, accept. Two. Second option, rejected. No dividend. We don't want dividend. Complete rejection. Or third proposal. No, let's be friends for life. That is the third option. So what is the next option here? Instead of 10 rupees, they can reduce it. The shareholders can reduce it. Instead of love, it can be friends. So instead of 10 rupees, we can 8 rupees. So here shareholders got three options. One option is what? Board has proposed 10 rupees. Full 10 rupees can be accepted. Shareholders say thumbs up. Full 10 rupees will give. Or the shareholders will say complete rejection. No dividend. The company is already in loss. So invest that money in the business itself. Develop the business. Then we'll take the profit. Like that the shareholders can say. Third option is the shareholders may say that, okay, 8 rupees alone you give. 2 rupees you guys itself give. But the shareholder does not have the right. The shareholder does not have the right to increase this 10 rupees. Able to follow? They don't have the right to say that, no, give me 12 rupees. No. Board has proposed 10 means that is the maximum amount. So board can accept 10 rupees as it is. They can say reduce it to 8 rupees or they can make it even 0. But they cannot increase to 12 rupees. Yes, boss. Yes. 100%. So all the shareholders are called in a AGM. That is called as an annual general meeting. In annual general meeting, there are certain agendas that will be discussed, for the approval of the shareholders. One of the agenda is this approval of dividend. So there, depending on the voting system, the majority of them will be voting. Now you may ask a question, sir. Let's suppose I'm the shareholder of the Reliance Limited. The AGM will happen in Bombay. For this, will I travel and go there? No. So for people like us who are sitting at the distance place, they'll be giving a postal ballot system where we can vote online. So whoever is voting to whichever point, that will be the final decision. Am I clear now? Today technology is there, so they take the help of technologies. In olden days, what used to happen? Whichever person is present in the AGM, only they can decide. If somebody is not coming, then he loses his voting power. Right? So today what happens at the home? So I've invested in multiple companies. So I get messages or the the form where I can do the voting. So if I submit that voting form and give it to them, then my vote has been counted for. Are you able to follow? So this is about the distribution of profit. Any difficulties in understanding this point? In case it is a draw, it is very difficult to have it as a draw, but in case if it has a draw, then second voting will happen, or they may propose something else. But one thing is for sure, from 10, they cannot increase it. So it's like, this thing only, what do you call it? Cricket match. If it's a tie, what happens? Super over. If super over becomes tie, again super over. Same thing. Now, audit. You know what is audit? What is meaning of audit?
So checking the books of accounts.
Who is saying this?
Sai Sanjay.
Sai says that, checking the books of accounts. So accounting is done by somebody. Now as a owner, see, company is very vast. Reliance Limited, if you see, the company is very vast. Do you think that every accounting entry, what the accountant is doing, the owner will keep a track of it? No. So what if that fellow is doing something wrong? How will I know? So what will the directors do? What will the company do? They'll appoint a CA who will do the work of checking the accounts. The process of checking the accounts is called as auditing. So they will check everything, not 100% on sample basis. So there is a mechanic of how to do the auditing. So that is something people will learn only in the CA course, or maybe to some extent in CS or a CMA course. 100%. Yes. Yes. So the person who's done the accounting is called as accountant. Now he can be a CA, he can be of any other profession. That is a different person, and the person who is doing the auditing, the CA, another person. So for example, when I was working in Deloitte, so I was deputed for a company where the accounting team was headed by the CA himself. So he takes care of accounting. As another CA, we do the checking, because there has to be a separate maker checker. You know, maker checker concept. The person who is making it different, the person who is checking is different. So that what if there is any mistake in between, that can be identified. So here also the maker checker concept is there in the picture. So accounting is done by somebody else, auditing is done by somebody else. Now, audit of the books, that is checking of the accounts, is not mandatory in partnership. It is not mandatory. Whereas audit of the books of accounts in companies is 100% mandatory. See here, there is a limit. See, audit is of two types: audit by partnership law, audit by tax law. Partnership law does not impose any compulsion. Please be very careful. Partnership Act, which is our rule book, they do not compel. But tax law, income tax law, they have a rule saying that if you are crossing a particular limit, if you're crossing a particular amount of turnover or profit, then you have to audit. But here we are not discussing about income tax law. We are talking about the original law, which is partnership law and the company law. Income tax law is different. So income tax law says that partnership concern, if you are crossing a particular limit, you audit. We're not talking about income tax law here. We're talking about the partnership concern and the company law. Partnership concern, does it, makes any compulsion? No. But company account, whatever be your limit of turnover, whatever be the limit of the profit, they will not take into consideration. Even if you're a startup, you have to compulsory do the audit. Auditing right from day one, right from the company is born, right from the date the company is born, auditing is mandatory. Am I clear or not clear? So who is giving this mandate? Company law is giving the mandate. Management. Business may be managed by all the partners or any of them acting for all. This point we know. Business is managed by the directors who are elected by the shareholders. Directors, what is the name? By name itself, directors means what? These are the people who direct the people to do the management. So directors will have their respective team members. So they will tell that you do this, you do that. That's why they are called as directors. So business is managed by the directors who are elected by the shareholders. We are electing them. Next, transfer of shares. A partner can transfer his profit share to other person as is provided in the partnership deed or with the consent of all the partners. If I don't want to become a partner, I retire, I can give my share to somebody else. So what happens? The old partnership deed is cancelled, and in place of the new partnership deed is being created. This is partnership. In case of transferability of the shares, we have discussed already in the characteristics. What happens in case of public company? If you're a public listed company, transferring is easy. If you're a public unlisted company and a private company, transfer it is slightly difficult, which is subject to articles of association. Except in case of unlisted company, except in case of unlisted and private company, transfer of shares is not restricted. Language is twisted. Except for unlisted and private companies, transfer of shares is not restricted. This is a negative sentence, which means what? You can transfer the shares easily for a listed public company. But for an unlisted public company and the private company, the restrictions are there. That is what they're trying to say. This kind of language, when you see, this is called as negative formation of sentence. This is called as a negative formation of sentence, where the starting itself is negative and here also it is negative. Negative makes it positive. Too much of negativity? Comfortable? Right? So language is very simple. In case you are a listed public company, transfer of shares is easy because I can transfer on my phone. Listed means what? Listed on stock exchange. Public company, transfer is easy. One click buy, one click sell. But if you're an unlisted company, you're not listed anywhere. If you're not listed, you cannot come on my phone. Private company can never come on the phone. So where is the question of transferring it? So transferring is restricted. I'm not saying it is impossible. It is restricted because articles of association should permit. After they have to follow so many other procedures. So restrictions are placed. Am I clear? Transfer of shares in the partnership happens in case of CPSR, in case of admission, in case of retirement. In all the three cases, transfer of shares happen. In CPSR, what happens? All the three parties were equal. C says that today I don't want to work too much. So I will give my share to somebody else. So cancel the old agreement, create a new agreement. So CPSR admission retirement is about transfer of shares. Transfer of share means what? Transfer of share of profit. That's why I say share means share of profit. That relation is very important. Business, a partnership can carry on any business if all the partners agree. I started Fortune's Fund Learning Academy. I'm doing academy related stuff. Tomorrow, let's suppose I want to keep popcorn and sell that. I have an option there. I can keep popcorn. All of you are sitting, you like popcorns, right? And you feel hungry at 6:30. So I'm thinking that why can't I keep popcorn? Then I'll start keeping caramel popcorn. And what we get in Spice Cinema, that all the popcorns I'll keep. Then slowly I'll start providing Red Bull, because Red Bull gives you wings now. You can fly nicely. You will not feel sleepy. Right? So I can start that. So in partnership concern, there is no restriction. Whenever I want, I can start any business. But in companies, can you do that? No. Why? Because there is something called as Memorandum of Association. Shortly we call it as MOA. In MOA, when you register the company, this MOA is supposed to be filled when you're registering the company. At the time of registering the company, you have to tell the government that what business are you going to do. So if you tell that you're going to run the academy, you are supposed to only do the academic related activities. Then, sir, if I want to sell popcorn, you have to cancel the old MOA, file a new MOA with the government telling that I want to do this business also. Are you able to follow? In sole proprietorship concern, partnership concern, who's going to question? Because you're not registering with any authority. You don't have to ask anybody. But here you're registering with the government boss. So government is keeping an eye on what all you're doing. So you're telling government that I want to start academy. In side gap, you're starting what you call popcorn business, means then government has to know now. So a company can carry only that business which is permitted by the object clause of MOA. In MOA, there are 6 clauses. One clause is object clause. MOA we are going to study in the next class. MOA, there are 6 clauses. In that, one is object clause. What is the objective of registering your company? Sir, I want to do coaching. I want to start a coaching center. You are permitted to do only coaching center, is what government tells you. If you want to do anything other than that, you have to cancel the old MOA, which means you have to amend the old partnership, old MOA telling that, sir, I want to do this business additionally. Government will say, okay, approved. Only then you can start the new business. I mean, in that company itself, we can start the next additional business. Are you able to follow? If partnership is registered, registration of partnership is possible only in LLP, because LLP is registered. Normal partnership, you are not registered anywhere. Am I clear? LLP is also, the rules is similar to companies. Somebody asked me something. Yeah. LLP, if you see, majority of the rules and regulations for LLP is coming from Companies Act. Though LLP has its own act, but similar rules has been given to them also. But let's not discuss about LLP. Coming to winding up. Winding up means what? Closure of business. A partnership may be wound up by an agreement or by order of court. In dissolution, we agreed. That is very, very important, guys. In dissolution, we agreed that what all could be the reasons for the winding up of the business. So as per that, the business will be closed. In case of the firm is unable to pay the debts because of the Insolvency Act will apply. And by that virtue, the firm will get closed. So we have studied about the closure of the business in the dissolution chapter. Here, guys, I told you very clearly, a company can be wound up only by the process prescribed under the Companies Act 2013. This point I gave you a glimpse when we discussed dissolution. I told you that a company can be closed only by following the winding up process. There's a winding up process given in the company law. Only by following those steps 1, 2, 3, 4, then the company can be closed. In partnership, let's suppose there are 2 partners. One dies. Second time, what happens? One dies. With one person, I cannot run the partnership concern, because for partnership concern, minimum 2 people has to be there. One died. Immediately, the business has to be dissolved. But here, what happens? If there are 2 directors, if two shareholders, in that one dies, the law will give you a time limit within which you have to appoint another shareholder, or you dissolve it by the winding up process. If you fail to do both, if you're not able to allocate a new shareholder, or if you're not able to wind up the company, then there is a penalty that is applied to you. But winding up will not happen automatically. So you have to keep on paying the penalty unless and until you fulfill these 2 conditions. Are you able to follow? So here, the closure of the business is happening only and only if you follow the steps that is given in the winding up procedure of the Companies Act. There's a separate chapter on the winding up procedure, individual chapter. I think that is there in the CA intermediate or CA final level, or CS executive or CS final level. Am I clear? I'm telling you guys, what we're learning is just 1%. I don't know if even if it is one person, because company law, there is altogether a big chapter, whole subject. Company law is one single subject. People study this entire law as a one single subject for 100 marks. We're just learning. This is just 1% or less than 1%. It is that big. It is. Stability of the business. It is affected by the death of a partner, retirement or insolvency of a partner. It affects. I said, 2%, one died. Another person cannot run the show. It will be dissolved. So the business stability is affected. No? The stability of business is gone. No? Here, the shareholder's death, insolvency or transfer of share does not affect the continuity of the business. Am I clear? Because who's running the show? Management is running the business. So if shareholder dies or becomes insolvent, how does it matter to the company? How does it affect the company? His capital will be replaced by somebody else. So let's suppose Mr. X is invested. Mr. X has invested the shares in the Lands Limited. He died. His money is still there. So let's suppose this phone was operated by whom? Mr. X. He died. Who will operate his phone? His wife.
Her name is wife.
Yeah, for anybody. Basically, a nominee or some other person. So that is the case. So if Mrs. X doesn't want to continue, investing, she can withdraw the money, which means what? She will sell this share to somebody. Somebody else will buy, no? So capital of the business is not affected. Let me tell you one point very clearly. If you transfer the share, for example, understand this point very nicely. X, Y, Z are 3 shareholders. Each one of them have given 2 lakh, 2 lakh, 2 lakh, 6 lakh. All these are shareholders. If now we have to have 7 members. Now take X, Y, Z, A, B, C, D. How many? 7 totally? 2 lakh, 2 lakh, 2 lakh, 2 lakh. How much totally? Guys, how much altogether?
14 lakhs.
14 lakh. Okay. This is the total capital. This money is with whom? Company. So let's suppose D dies. Or D wants to transfer his shares to somebody else. So let's suppose D wants to transfer. D is transferring this to, let's suppose, P. D is transferring this to P. So D will give shares to P. P will give money to whom? D. Is company's capital getting affected here? So company, what money it got in the beginning, the same money is there with the company only. So when you transfer the share, the money is rotating between us. So D is giving the share certificate to P, then P is giving the money. So here, when I press buy, which means I'm paying the money and getting the share. And to whom money is going? It's not going to company, it's going to shareholder. Of course, the shareholder's account is not directly going, it is routed through stock exchange. So P will pay money to stock exchange will pay to the shareholder. So that is a different process. We are not getting into that process. All I'm trying to make you understand here is that the transfer of shares will not affect the capital of the company. The business can do, the company can do its business aram se. There's no problem for that. Am I clear or not clear? Now this 2 lakh worth of share, P can pay it for even 3 lakh rupees. So P has to give 3 lakh rupees. So 1 lakh is a profit for D. See, very simple logic. You are a trader in the market, shareholder. You're transferring the share. If you get the profit only, you will trade. No. If company is getting the profit, why will you trade? Boss, let's suppose I've invested 5 lakh rupees in stock market, which means what? I'm buying 5 lakh worth of share. I'm buying 5 lakh worth of share. I'm selling it for 6 lakh. Who got that 1 lakh profit? I got. So D has share capital worth 2 lakh. When he sold it for 3 lakh rupees. So P is giving how much money? 3 lakh. So D made 1 lakh profit. So 3 lakh, P's investment is what? 3 lakh. 2 lakh is in the company, 1 lakh is given to D as profit. Am I clear? Online people, there's no questions from all of your side. I don't know if you're participating, not participating. I'm telling you the kind of knowledge what you can get from me. I can 100% tell on the recorded class, this you will not get it from any other teacher. Because we've been born and brought up in the CA field for 5-6 years, doing all this only. So this is all running in our bloods. So the amount of visibility that I can give you in this chapter is too large. So if you have any questions, please be vocal enough to ask. Yes, boss. Correct. That's what I said you. If the shareholder dies, the shareholder will be replaced by another shareholder. If director dies, the director is replaced by another director, because there's not one director who's running the show, boss. The multiple directors who are running the show. That's why the design of the company has been done in such a way that you cannot screw up anywhere. We'll discuss about the directors also in the upcoming slides. I think there is a particular slide where it talks about directors also.
The number of directors set up by the doctor.
Here it is, number of directors.
Sir,
Number of directors. We'll be discussing very shortly. The number
Sir.
of directors. Yes, boss.
sir, directors are also one of the members, sir.
Directors could be one of the members. It is not necessary. See, one type of a director could be the shareholder also. But there could be some person who wants to become a director but does not want to become a shareholder. For example, Mr. Mukesh Ambani sir is telling that, Pratik, I'm giving an offer to become a director of that particular company. So I become the director. For doing my job, I'm getting salary. But somehow, let's suppose I'm not interested to invest in that particular company because company I know is not doing well at the share market. Let's suppose they're doing quite well, but still I'm telling. Then let's suppose I don't want to become a shareholder. So it's my choice. So becoming a director or not, it's my choice. Becoming a shareholder or not is my choice. So both are different. Director is being management, shareholder is being the owner. So it's absolutely my choice. So there are certain directors who are directors come shareholders. And there are certain directors who are only the directors. They don't want to be a part of the owner. So both options are available.
So in case loss means till how much share they got, they need to pay.
No, don't get into that. It'll become too messy at this early stage. Let's not go. So Sai Siti, have I answered your query?
Not me, sir. I think someone else, sir.
Somebody who asked this?
Sir, Amrit.
Okay, have I answered your query, Kana?
Yes, sir.
Okay.
Sir, I want out, sir.
Yes, boss.
Sir, you said since there are so many owners who invest the shares, so they arrange the board of directors. But then you're saying that board of directors can or cannot be the owner of the company.
Yeah, see, shareholders will decide who can be the director to manage it. So let's suppose all of you are shareholders. You are all my students. You are shareholders. You are proposing that Pratik sir is to be the director of this company. Why are you proposing my name? Because I'm good at management.
Yeah.
So you are proposing me to become a director. But becoming the shareholder of that company or not is whose choice? Your choice or my choice? To become shareholder is my choice or your choice? Because if I choose to become a shareholder, I have to pay money, not you. So if I don't have capital, if I'm not interested to pay capital, then I will not become a shareholder. No? So please understand, the shareholders are selecting the directors to manage the business. They're not telling that you become the shareholder. You're getting my point?
Okay. Yes, sir.
Shareholder is my choice. Whether I want to invest the money in that company or not is my choice. Am I clear?
Yes, sir.
Okay, guys, I'm giving you a quick 5 minutes. Let's take a break. We have to come and discuss the types of company. 5 minutes is the break. 7:40 sharp will start. Yes, people, welcome back from break. So let's continue with the next concept, guys, which is type of companies. Now there are 3 different kinds of companies, guys. 3 different kinds of company. The first kind of a company being called as one-person company. This is the first form of a company or a first type of a company. Aditi. Second, it is called as a private limited company, which we are very familiar with. Correct? Now we often come across this word private limited company. And the third being public limited company. Guys, this OPC is a concept that was introduced in Companies Act 2013 only. Prior to that, before Companies Act 2013, the 2 kinds of company what we had was one private company and second was public company. Under OPC, under Companies Act 2013, the OPC was being introduced. As the name goes, one person company, which means what? One shareholder. Now let's understand this in detail. Companies are of the following 3 types. One is OPC, second is private company, third is public company. One person company. One person company is a company which has only one natural person as a member or a shareholder. Only one natural person, which means only a human being can form a OPC. Can one company form another OPC? For example, private limited company. Private limited company is artificial person. Can this company form an OPC? Not possible, because for somebody to form an OPC, it has to be a human being, natural person. So only natural person can form a company. So he only can become a member or a shareholder. So only one shareholder or one member. That is, member is shareholder. Now, Section 2, subsection 62 of the Companies Act 2013 defines, please understand, Section 2 of the entire Section 2 of the Companies Act talks only about the definition of each and every items. In company, there are a lot of things that needs to be defined. I need to explain a lot of things now. So Section 2 keeps on defining something. So Section 2, subsection 62, the 62nd point of this subsection 2 talks about OPC. So Section 2, subsection 1 is meaning of something else. Section 2, subsection 2 is the definition of something else. Section 2, subsection 3 is definition of something else. Like that, if you come in the list, this is subsection 62, which is defining the OPC. So Section 2, subsection 62 of the Companies Act 2013 defines one-person company. As one-person company means a company which has only one person as member. Member here means owner. Owner here means shareholder. Only one shareholder allowed. Rule 3 of Companies Incorporation Rule 2014. Now, what is this Rule 3? See, one is this Companies Act. Companies Act is giving the major rule, major law, what you should do. But the explanation to that law is given in the rule book. Are you able to follow? Law is given. Law is framed, but you don't understand that law. So that law is interpreted in the Rule 3 of Companies Incorporation Rule 2014, which explains you certain things. Relating to one-person company says that. So Rule 3 is saying the details in detail. They're giving more information saying that, very important point. Only a natural person. So point number 1, who can form OPC? Natural person. Only a natural person being an Indian citizen. Second condition is what? He has to be an Indian citizen. How do you get Indian citizenship?
Born in India.
Indian citizenship is got by birth. If you are born in India, you are called as a citizen of India. Now let's say that somebody is born outside India, right? If his origin is from Indian, if his parents are Indian, then he'll get the Indian citizenship. Let's suppose there is third person by name Chris Gale. All of you know Chris Gale? Of course. Chris Gale wants to get Indian citizenship. So what he has to do, he has to apply for that for a country. If our country is granting him the Indian citizenship, then he becomes an Indian citizen. Are you able to follow? So Indian citizenship comes by 3 things. One is by birth. The birth should happen in India. If you're born out of India, but your parents are Indian citizen, so you are Indian origin. By that virtue, you are becoming an Indian citizen. Happens, no? A lot of time parents are born in India. They go settle abroad, let's say Australia. So in Australia, the kid is born. So he's an Indian citizen by the virtue of Indian origin. Third is what? You have to apply for the citizenship. If the government is giving you, then you become an Indian citizen. So first criteria to form an OPC is that you need to be a natural person, human being. Second, you have to be Indian citizen. Third, you have to be resident in India. Resident means what? You have to stay in India. Stay in India. This concept is being governed. Who can become a resident of India? Who can become a resident of India? That point is mentioned in your income tax rule. So income tax rule says that if you are staying in India for 182 days, for 182 days or more, then you become a resident of India. So if you stay less than 182 days, let's suppose you're staying for 180 days, then you are not a resident of India. So it means third point is failing. In that case, you cannot form a OPC. There is one more criteria. I'm not going in detail. So resident of India means the person should reside in India for a particular period of time. Who is giving that particular period of time? Income tax law. If all these 3 conditions, if you cumulatively satisfy, these are the 3 conditions, 1, 2, and 3. If you satisfy all these 3 conditions, only then can you form the one-person company. Am I clear or not clear? Or to become a nominee. Who is a nominee? Let's suppose Mr. X is the person who is forming the company OPC. Now it is compulsory for Mr. X to appoint a nominee. So in this case, let's suppose Mr. X is appointing Mrs. X as a nominee. What is the role of a nominee? The role is exactly of that of an executor. If you remember, in the death of a partner, the person dies. Who will take care of the remaining responsibilities, or to whom should we give the money? To executor. In the case of the retiring partner's case, who is that? It goes to retiring partner. So forget retirement case. In case of death, there has to be somebody, So if Mr. X dies, on behalf of him, somebody has to collect the money from the from the company. Somebody has to pay the money to the company. So who will do that? So X will appoint, after I die, Mrs. X will be responsible for certain things. If you want something, she will give. If you want to give something to me, you will give it to Mrs. X. So for you to become a nominee also, Mrs. X also has to satisfy these three conditions. So Mrs. X has to be a natural human being. She has to be an Indian citizen and she has to be a resident of India. All the three conditions, it has to be applied for even nominee, which means what? Mr. X, who is the member, for him to start OPC, he has to follow those three conditions. Plus, for Mrs. X to become a nominee of that particular company, even she has to follow those three conditions. Are you clear with this first point? Please tell me yes or no.
Yes, sir.
One person can form only one OPC. So Mr. X, can he form multiple OPC? No, he can form only one OPC. Can Mrs. X be nominee of multiple OPC? No, she can be nominee of only one OPC. Which means what? Mr. X can be OPC, member of one OPC. He can be a shareholder of one OPC. At the maximum, he can be a nominee of some other OPC. One shareholder, one nominee allowed. So X can become, Mr. X can be shareholder in one OPC and he can be nominee in another OPC. Mrs. X can become shareholder in one OPC. She can be nominee in another OPC. But these people cannot have multiple OPC or multiple nominee they cannot become. Am I clear? One person can form only one OPC or become nominee of only one such company. Clear, not clear? Online people, any difficulty in understanding this particular point?
No, sir.
No, sir.
No, sir.
Yeah, so Mr. X can be shareholder in a different OPC. Let's suppose the OPC name is Fortune FFLA. FFLA is one OPC. So Mr. X can be shareholder of FFLA. Can he be nominee? Yes, but nominee of another company. Let's suppose CA.Prathik Academy. So in CA.Prathik Academy, who is the owner? Let's suppose Mrs. X is the shareholder of CA.Prathik Academy. Nominee can be somebody else. Who is Mr. X? Nominee can be for FFLA. Sorry, FFLA. So if you see here, Mr. X is the shareholder of FFLA and Mrs. X is the nominee of FFLA. Mr. X is the nominee of KA and Mrs. X is the shareholder of KA. Now, apart from these, can they become the can they form one more OPC? Can Mr. X become the shareholder of one more OPC? No, not possible. Can they become nominee of another OPC? Not possible, because one OPC, one shareholder, one nominee only allowed. That you have fulfilled. So you cannot become another shareholder of that OPC, or you cannot become the another nominee of the OPC. Am I clear? Next, it cannot be formed for a charitable purpose. What cannot be formed? OPC cannot be formed for the charitable purpose. So which means what? OPC can be only for created for the purpose of doing business, where the intention is to earn profit. Charity, not allowed. If you want to do charity, you have to form trust. You have to form a society, NGO. So where you'll be governed by the trust rules, society rules. That is for the charitable purpose. If I want to do some charitable related activity, then if you want to form an OPC, then OPC is not the option for you. OPC is only for the purpose of creating a profitable business. The intention is purely to do business. So you cannot form any OPC for the purpose of charitable activities. Am I clear or not clear? Now, OPC cannot carry out non-banking financial investment. You know what is banking activity? Banking means what? Lending business. They lend the money and they earn interest out of it. That is called as banking. Bankers or the bank is being governed by the banking rules. So in India, can only bankers lend? No. There are non-banking financial institutes. Which means what? They don't come under the banking regulations. They come under some other regulations, but they can still do the lending business. Those people, the people who are not coming under the banking rules, but still can do the lending business, is called as a non-banking financial corporation, which is shortly called as NBFCs, or we call it as non-banking financial investment. So what is their role? Their role is to do the investment activity. Their role is to do the investment activity. Let's suppose I started FFLA. The purpose of this FFLA is to do investment. Let's suppose Srivarshan is starting one startup. I'm giving 1 crore to him. Let's suppose Riddhi is starting one startup. I'm giving her 2 crore rupees. So what is the purpose of my company? To invest. So can a OPC be created for investment purpose? No. So if you want to do the investing business, either you start a private company or a public company, but OPC you cannot do. OPC cannot carry out non-banking financial investment activities, including investment in the securities of any body corporate. If I'm giving 1 crore rupees to Srivarshan, I'm investing in the security of his body corporate. Here means company. Security means share. So if I give 1 crore rupees to Srivarshan and he's giving share to me in return, that also I cannot do. OPC is not allowed. So I cannot lend for interest. I cannot invest for earning the dividend. If you want to do investment, a lot of investors invest money in the company now. They are not OPCs. Either they are private limited companies or public limited companies or even partnership concern for that matter. Mostly they are all companies only, but they cannot be OPC. They can be private or public, but not OPC. Am I clear or not clear with this?
Sir, can you explain 1 second, sir?
Whole point.
No, sir, the last part.
Last part, this including investment in securities of body corporate.
Yes, sir.
So body corporate means company. Company is called as a body corporate. Securities here means shares and debentures. So OPC cannot do investment in shares of the body corporate, which means what? I cannot give 1 crore to Srivarshan where he gives me shares back. I cannot do that. So if you want to invest in somebody's company for getting the shares out of it, you cannot form an OPC. You can form a private company or a public company, but you cannot form an OPC. So OPC cannot do the charitable business. OPC cannot do NBFI or NBFC related business, which means they cannot lend the money for loan. They cannot invest in any company as a shareholder. Am I clear now?
Yes.
Can I start an OPC for buying and selling laptops? Yes. Not restricted. Can I do teaching related activities by forming OPC? Yes, not restricted. Now, next important point. OPC's paid up share capital should not be more than 50 lakh. So we'll be learning about the different kinds of share capital in the upcoming classes. There is authorized share capital, there is issued share capital, there is paid up share capital. Paid up share capital means what? The capital of the company. The capital what I invested. So 50 lakh rupees I'm investing in the company. That is called as infused capital, paid up capital. So OPC cannot have capital more than 50 lakh. Now let's suppose I want to do the construction of apartment. For constructing apartment is 50 lakh capital sufficient? I want to construct 300 apartments. With 50 lakh capital, can I do the business? Then the question comes is, can that particular person form OPC to do the business? No. Because in that business, you need capital more than 50 lakhs. So for you, the OPC option is ruled out. Only in that case, you have to follow either private company or public company. Now you may ask a question, sir, there's one person, let's suppose FFLA. FFLA started as OPC with 10 lakh capital. Gradually, they started expanding in multiple cities. So they wanted more capital. So 10 became 20, 20 became 40, 40 became 50. Now, after a few years, now they want more capital. So now from 50 lakh, they want to make their capital to 70 lakh. Is it possible? Yes. But you will lose your status of becoming an OPC because you'll be converted to a private company automatically. Because for you to have the status of OPC, your paid up capital at any point of time should be 50 lakhs. It should not be more than 50 lakh. Means up to 50 lakh it can be. Less than 50 lakh means what? 49 lakh 99,000. 999. Up to 50 lakh you can invest as a capital. More than 50 lakh if your capital crosses, then you have to convert into private limited company. It is compulsory. If you don't do it, penalty will be applied.
So we need to register once again.
You have to do the transferring process. So again, that process, whatever is given in law, that you have to do. We're not discussing the process in detail, but I'm just telling you, for an OPC, the maximum paid up capital what they can have is only 50 lakh. Am I clear with this point? Any doubts here, please? Online people, any doubts here?
No, sir.
No, sir.
Now, F point will come after this point. Next point, a one-person company should have at least one director, but not more than 15 directors. OPC will have minimum one shareholder, maximum one shareholder, but director minimum one, maximum is 15. See, owner has to be one, but to manage that business, I need more directors. No? So I can have more directors, but maximum directors will be 15. More than 15 directors, you cannot appoint. You cannot appoint. If you appoint more than 15 directors, you're violating the law. So penalty will be attracted. So minimum one, maximum is 15 in terms of directorship of the company. Am I clear? So for OPC, minimum shareholder? One. Maximum shareholder? 1. Online people, can you respond? For OPC, minimum
Sure.
shareholder,
1.
1.
maximum shareholder,
1.
minimum director,
1.
maximum director,
15.
50. Now, F point is very crucial. Please pay complete attention. That is OPC's average annual turnover of 3 years should not exceed 2 crore. For you to remain OPC, the turnover of the last 3 years on an average should not be more than 2 crores. So what do you mean by this? First year, second year, third year, fourth year, fifth year. First year, you're starting the business. Do you have any previous 3 years? No. So here you are OPC. Let's suppose here your turnover is 1 crore. Okay? Second year doing the business. When you start the business in the second year, you have to check what is your status. Are you qualified to become an OPC or are you disqualified? Because if you're disqualified to become an OPC, you have to convert yourself to private company. So again, second year, in beginning, I'll check what is the turnover of the last 3 years. So before second year, I have only 1 year. So what is the average of 1 crore divided by 1? So 1 crore. I mean 1 crore divided by 3, sorry. 1 crore, I need average of 3 years. So last 3 years turnover is 1 crore divided by 3. So it is how much? 33.33 lakhs. 1 crore divided by 3 is 33. 1 crore divided by 3, 33 lakh. 33 lakh, 33,333. So can I say you have the limit? Because you have the limit to touch up to 2 crore. Up to 2 crore, you can become an OPC. Average turnover. Average 3 years turnover should be 2 crores. So here, my turnover, average turnover of 3 years is how much? 33.33 lakh. So which means I have not breached the 2 crore turnover limit. So which means what? In the second year, I can continue to become OPC. So here my turnover is, guys, let's suppose 2 crore. Okay? Now coming to third year. Third year beginning, I need to check whether I still have the status of OPC. So what will I do? I'll take the previous 3 years turnover. So I have only previous 2 years here. So 0 plus 1 crore plus 2 crore. 0 plus 1 crore plus 2 crore. Because I have only 2 years of profit now. Divide by 3. How much? 3 crore divided by 3. 1 crore. So here 1 crore is the average turnover. 2 crore is the limit. I have only reached 1 crore. So third year, can I continue to become an OPC? Third year, you can continue to become an OPC.
Okay.
So here in third year, let's suppose my turnover is 3 crore. My third year turnover is 3 crores. Now I'm stepping into my fourth year. So fourth year beginning, you need to check whether you have the title of OPC, whether you have the status of OPC, or have you lost it. Aditi, concentrate here. Now here, guys, I'll take the average profit of last 3 years. So last 3 years profit means what? This, and this. So 1 plus 2 plus 3 crores divided by 3, which is 6 by 3, which is 2 crores. I've touched 2 crores. Up to 2 crores you can touch. OPC's average annual turnover of 3 years should not exceed 2 crores, which means up to 2 crore is allowed. So fourth year, guys, do I have the status of OPC? Can I continue as OPC? Because I have not crossed 2 crores. So I can become an OPC. In fourth year, let's suppose the turnover is 4 crore. Now I'm in the fifth year. In the fifth year, you will take immediately pre-3 years here. Previous 3 years. So which 3 years you will take? Previous 1 year, previous 2 year, previous 3 years. I have to take immediately 3 previous years. So 5K before, what are the 3 years? 4, 3 and 2 year. Correct? Now what is the average? 2 plus 3 plus 4 divided by 3. This 9 by 3, which is how much? 3 crore. Now can I say I've crossed the limit of 2 crores? In the fifth year, can you continue to become an OPC? No, you have to convert yourself to private company.
Private company.
OPC, average annual turnover of 3 years. Average annual turnover. Average of 3 years turnover should not exceed 2 crores, which means average should be 2 crores only. If it crosses more than 2 crores, then you have to convert yourself to private company. If you don't want to convert to private company, you do the winding up of the company. You have only 2 options. Either wind up through the wind up procedure or convert to the private company. You have only 2 options. If you don't comply with these 2 options, you will be facing the consequences. Penalty will be applied. Even after penalty applying, you're not listening, then you'll be jailed also. So whatever the rule is given, that rule. I'm giving example of it. Don't shock like this.
Then what is the advantage of 1%?
Okay, the question is, what is the advantage of 1% company? You want to start a company. In private company, there are minimum 2 owners. Minimum 2 owners required. Now, Dhiru does not want any owner except him. Dhiru does not want to have any owner except him. He wants the single owner because he feels that I don't get along with other people. There'll be a conflict of decision making. So I want to be a single owner. So for you, what is the option? OPC. If you don't want OPC, then you have to go with private company. Private company, 2 people, conflict will come. Now you may question, sir, why should I create OPC? I'll go for a sole proprietorship concern. Now that is the highlight here. So let's understand the difference between OPC and the sole proprietorship concern. But before that, are you clear with these points?
Sir, what about the liability part, sir?
Which liability part?
What about the liability of 1% company, sir?
Same as what we studied for private and public.
Okay, sir.
So I've noted down few points which I will discuss with all of you, which is the difference between, I could not make a PPT, I didn't find time, but I can maybe put it on whiteboard. This is going to be informative for all of you. So difference between OPC and a sole proprietor. First is, guys, if I talk about liability, OPC's liability is what? Limited liability. Because there is a limited liability clause which we studied and which we are going to study in detail in the next class. So for every company, this limited liability clause will apply. Whether you're OPC, whether you're a private company, whether you're a public company, this clause will be for everybody. When you studied sole proprietorship concern in the 11th standard, anywhere you learned that the liability is unlimited. Oh, sorry, whether the liability is limited. So sole proprietor, always the liability is unlimited. So can I say this is one of the strong reasons why you want to form an OPC? Because in sole proprietorship concern, what happens? If the business is not paying the liabilities properly, they can attack your private properties. Whereas in OPC, the liability holders cannot attack your private properties except in case of lifting of the corporate weight. Second point, OPC's taxation, the tax rate what is applied, taxation is as per private limited company. So for private limited company, what tax rate has been applied, that is being followed. Whereas for the sole proprietorship concern, taxation as per individual tax slab. I'm not going in detail because this is not required. So there is a taxation benefit also. The tax rate what is applied is different for both the people. I'm not going in detail because it is not applicable at your level. Next point is compulsory conversion. This compulsory conversion comes where? The compulsory conversion comes when you breach the paid up capital limit. If you cross the paid up capital 50 lakh, more than 50 lakh, you're supposed to convert to private company. If you breach the turnover limit, you're supposed to convert to private company. Like that compulsion, did you find anywhere in the sole proprietorship concern? No. So under the sole proprietorship concern, there's no compulsory conversion. No compulsory conversion. Any problem here? If I talk about compliance means what? Compliance of what? Compliance means doing something of what? Law. The rules and regulations that is being given for OPC is very, very heavy. If you don't do this, this penalty. If you don't do this penalty. If you don't do this jail I'll do. Like that, the requirement of compliance is very heavy. And the penal consequence is also very heavy. But for a sole proprietor, did you hear anywhere that if you don't do this, I'll put in jail? No. So there the compliance is less. So compliance is heavy. For a sole proprietorship concern, compliance is less. Compliance is less. Any difficulty, guys? Please tell me. Online people are not getting any responses. I prepared so much for all of you, man. Little bit you're cheering up.
What else, sir?
Understanding, sir.
OPC registration is compulsory. Registration compulsory. For sole proprietorship concern, have they told that the registration is compulsory? No. So no compulsory registration. No compulsory registration. Am I clear? Then For OPC, you have the benefit of perpetual succession, which means what? If Mr. X dies or if he becomes bankrupt, nominee Mrs. X can run the business or some other person can come and continue the business. You will be given a time gap. Within that time gap, you have to appoint a new shareholder. There is no need for closing the business. But a sole proprietor, if it dies, you cannot continue in the same name. The same person cannot continue. The different person only has to continue. So there is no perpetual succession here. There's no perpetual succession here. Is this difference sufficient enough for difference between OPC and the sole proprietorship concern? Taxation point, we're not going in detail. So there is different tax rate. So let's suppose here the tax rate is 25%. Here for sole proprietorship on an average, let's suppose that rate is 22.5%. I'm just telling for namesake. This is not real. I'm just telling for namesake. Let's suppose here the tax what you have to pay is 25%. Here the tax what you pay is as per slab. The average of the slab is, let's suppose, 22.5%, which is beneficial. This is beneficial. Or let's suppose if this is 27% on an average, which is beneficial. This is beneficial. So when you form OPC, you have to check the tax rates. If the sole proprietorship tax rate is better, go with that. So basically, these are all the points that you need to keep in mind. So when I was practicing CA, I think 3-4 years ago, so people come and ask me, sir, should I go for OPC or a sole proprietorship concern? If yes, what is the difference between the two? If I have to go for OPC, what is the advantage? What is the disadvantage? If I go for sole proprietorship concern, what is the advantage and disadvantage? So like that, we have to make them understand. Are able to follow? So like that, even you should know that for doing a business, whether OPC is better or sole proprietorship is better. So you'll compare whichever is more advantageous, you'll go with that. Whichever is more advantageous, you'll go with that. Am I clear or not clear?
Yes.
Who said in sole proprietorship capital is limited? Where did you study? I didn't study. If you can tell me, I'll study income. Clear with this point? So can I explain the concept of private company? We'll do with that. I think today we'll have time only for private company. So let's do it. Online people, any doubts so far with whatever I discussed?
No, sir.
No, sir.
No, sir.
No, sir.
Now, the second kind of a company is a private company. But before that, let's one more important. If you're a OPC, whatever is your name, let's suppose my business name is FFLA. So FFLA, OPC. So at the end, you have to add the word OPC. Or else, how will I know that you're OPC? If you don't add the word OPC, then you could be a sole proprietor also, no? So whether you are sole proprietor or you are a OPC, how will I know? So for that purpose, after the business name, OPC is mandatory. If you're a private company, then I have to put FFLA Private Limited, which means this indicates that you're a private limited company. If you're a public company, it should be FFLA Limited. If private is there, private limited. If limited is there, public limited. FFLA Limited means what? Public company. FFLA Private Limited means private company. FFLA OPC means OPC. Are you clear with this? Now, private company. A private company is one which has minimum paid up share capital as prescribed and which by its articles. So which means what? For a private company, law does not say this much should be your capital. Who will say? Articles of association. Articles of association is a rule book for the company. So who creates that rule book? The company only creates. So I can decide my capital should be 10 lakh, 20 lakh, 1 crore, 2 crore, 10 crore. It is up to me. There's no limit. In OPC, there is a limit. Limit is maximum. OPC, what is the paid up capital limit? 50 lakh. So here, there is no assets limit. The limit what you fix in articles of association, that will be the limit. So in articles, you are fixing that my capital should be 10 crore maximum. Then you can have only 10 crore. If you want to go beyond 10 crore, then you need to amend your articles of association. This is, I'm talking about the total paid up capital. Total, not each person. Total. When we talk about paid up capital, it's always the total. Now, point number 8. Now, there are certain features in the private company which you have to be aware of. First feature, a private company is restricted the right to transfer its shares. In the public listed company, transfer is free. In phone, click of a button, I can buy and sell. In unlisted public company, in private company, you can transfer, but it is restricted. So where is the restriction given? The restriction is given in articles of associations. Restrictions means what? For you to transfer the shares, this condition, if you satisfy only, then you can transfer. If you fail to satisfy that condition, then you cannot transfer. So they're not telling that you cannot transfer. You can transfer, but conditions has to be followed. So what is happening? The restrictions is being placed. You're not able to do freely. If same thing I have to do with the listed company, I have to buy shares today. With the click of a button, I can buy, boss. There is no condition that I have to fulfill. The condition is you have to give me only paisa. One hath paisa do, dusra hath share lo. Same thing here. Give one side money, take another side share. But here, there is certain procedure that you need to follow. If you don't follow those procedures, the transfer of shares become very difficult. Am I clear? So first is restricted right to transfer the shares. First point. Am I clear or not clear? Please tell me.
Yes, sir.
Yes, sir.
Second point, B point, I'll come later. C point, prohibits any invitation to public to subscribe for any securities of the company. All heavy words. Prohibits means what? Restricted. You cannot what? You cannot invite the public. For what? For investing in the shares of your company. Subscribe means what? Invest. Invite public. Prohibit means what? Not allowed. You are not allowed to get money from the public, which means what? As a private company, you cannot go to a random person, general public, and tell me, give me the money. If you want to get the money from the general public, you want to register as a public limited company. All of you know Paytm? Paytm. Paytm has done its listing recently, few months ago. That's a big story of Paytm. One day, if I get time, I'll tell what all happened with the Paytm investors. But Paytm was registered as a public company, which means what? It can take money from public. But it did not list, because for you to take money from the public, you need to list on the stock exchange. So when what Paytm was going for the what do you call it, public subscription, before that they had converted to public company. They had a public company which is unlisted. Public company unlisted. So if you're a public registered company, only then you can take money from the public, which means what? I'm issuing the shares to public. Do the company know each and every individual person personally? Let's suppose having Reliance Limited shares. Does Mukesh Ambani sir knows me personally? Oh, Pratik, come. You're a shareholder of my company. Come have a tea, coffee. If he meets me in Bombay, will he say that? No. So to him, I'm a general public. So sir has taken money from me. That is allowed only for a public company. As a private company, let's suppose Srivarshan is starting a private company. He's going to a random public in Bombay, telling that give me money, I'll do business and give profits. Can he do that? He is not allowed. So private person cannot take money from the general public. He can take the money from the person who he knows, friends, relatives, or directly a person who's interested in his business. For example, let's suppose Srivarshan does not know me, but I'm an investor who's investing in multiple places. He comes and tells me, sir, I have a very good business model. Please read the business model. If you're interested, invest. So I read everything. Relationship is established. I know him. Then I invest. So in the private company, the person who knows only invest. Randomly, nobody invest. Am I clear or not clear? Prohibits means restricted. To invite public. Subscribe means what? Invest. Securities means what? Shares. So you cannot invest, that is a public cannot invest in the shares of a private company randomly. Am I clear or not clear? Guys, am I clear or not clear?
Yes, sir. Clear.
Yes, sir.
Point number B, you have to pay full attention. I'll take at least 10 minutes. So please pay full attention. Except in case of one-person company, it limits its number of members, excluding its present and past employee member to 200. Very confusing language. No? So what are they trying to tell is that in a private company, minimum number of shareholders should be 2. Maximum limit is 200. So when you count this 200 people, you should exclude the present and past employee member. Present and past employee shareholder has to be excluded. Now, what is meant by this? Let's understand. Promoter. You know who's a promoter? Promoter is a person who starts the company, who's got the idea of doing the business. He's the person who's registering the company. Now, promoter can be of 2 types. Promoter cum Promoter means shareholder. Come director. Director means the person who is managing the business, which means who is employed. All the directors are the employees of the business. Please understand. If Mukesh Ambani sir is MD of a company, what is the relationship between Mukesh Ambani and the company? Employer-employee relationship. Am I clear? All the directors are employed to the company. So Mukesh Ambani sir is the shareholder, plus come means plus he is the director. Not every promoter wants to become a director because some promoter don't have the interest to manage. They only want to invest. Then they are called as promoter only. They are called as promoter, which means shareholder only. Clear with this point? Then employee. Because apart from director, there'll be other employees, no? Vice president of the company, president of the company, senior finance manager, CFO, marketing head, finance head, sales head. No, so many people are there. So those employee guys who are very good employees, no, the company give an option to make them the shareholder of the company, so that they get a feel that we are not only working for somebody, they also feel that they are a part of the company. Let's suppose I'm working in a company. I'm working very well. Let's suppose I'm the head of the finance department. So I'm doing well. Now company does not want to leave me. Company says that, Pratik, you're doing superbly well. I'm giving you a salary package 2 crore rupees. But in addition to that, I want you to become the owner of this company. So you become the shareholder also. So what will I have? When I work, I will not work with the mentality that I'm working for somebody else. Now, once I become the shareholder, I feel that this is my company. So you get a sense of ownership. Are you able to understand? So employee can also become a shareholder. So is every employee given that opportunity? No. You're given certain milestones. If you achieve those milestones, if you achieve those targets, then you are become the member of the company. You are eligible to apply for the share of that company. Are you able to follow? That is because as an employee, when you get shares now, you get at a discounted price. See, as an employee, you can get the shares from the outside market also. But in the employee contract, you're restricted. You're not allowed. Very few companies allow. So if an employee goes and gets this shares from the share market, you'll get at the market price. But if you're getting through the company, now you'll get a discounted price. For example, if I'm working in Levi's, right? As an employee, don't you think that I'll get a discounted price? Hello? There's so many people working at lifestyle. Do you think they're paying like you and me are paying in the MRP? No, they get a discount, 20-30% discount they get. Like that share also, if you get through the company, you'll get a discounted price. If you go and get it from the share market, you get at the market price. Are you able to follow? So employee is given an option that you want to become a shareholder or not. Employee says that, okay. So now guys, there are two kinds of employee. Present employee. Who is a present employee? Who's currently an employee, currently a shareholder. Present employee. One is past employee. Past employee means what? He was working in past. He became the shareholder in past, which means last year. Last year he was my employee. Last year he became my shareholder. So past employee. This is present employee. Present employee means what? Currently working. Currently working plus current shareholder. He's currently working and current shareholder. Past employee means what? Currently not working. He's not working with the company. He's working somewhere else. But he's a current shareholder. Still he's a shareholder because he's not sold the shares. He's still shareholder. Are you able to follow? So one category, two category. Third is outsider. Outsider. General public. These are also called as, you can say general public means they can be retail investors like us, or it can be institutional investors like venture capitalist. General public means retail investor. Who's a retail investor? You and I go and take shares from the share market. So you and I are called as retail investors. We are general public, no? We go and, so if you buy shares of any company, you are called as a retail investor because you buy in the small quantity. Now there are certain institutes which they buy in the bulk quantity. Bulk quantity. So there are institutional investors. They buy in bulk quantity. If they buy the shares of some company, they buy for 10 crore rupees, 20 crore rupees, 3 crore rupees. When we buy for 5,000 rupees, 10,000 rupees, 20,000 rupees. That much only I bought initially small quantities. Then as we got confidence in the share market, then we put more money. Now, promoter who is a shareholder. Now let's suppose there are 5 shareholders like that. Promoter who is 5 shareholders plus he's a director. Promoter only. Director means employee. Director means employee. This is a promoter who is only the promoter shareholder. Let's suppose this is also 5. Present and past employee. That is present employee. Let's suppose there are 25 this and this is 25. Outside is, let's suppose, $150. What is total now? Please can you tell me the total? 150, 200,
210.
210. The maximum limit is what? Maximum limit is what? 200. They are 210. Have they violated or not violated? You are telling that limit is maximum 200 excluding present and past employee. So in this 210, I'm supposed to exclude whom? Present and past employee, and also this, because director is also employee. So these boxes I need to exclude. Now count and tell me how many people are there.
155.
So these put together is 155. Now tell me, have I violated? So maximum is 200. When you count the 200, you're supposed to exclude present and past employee. Employee here also includes director, because director is also employee. So except employee, which means what? These 200 are purely the outside people. That is basically the external shareholder. Promoter can be included. Promoter is only the shareholder because he's not doing any work. No, he's just invested money. So what is the difference between this person and this person? Both are investing money and sitting quietly. No, are you able to follow? Are you able to follow? Now, I'm making this 250. I'm making this 250. Now tell me, guys. No, this is 250. Have I violated? Because the blue box I have to eliminate. So 5 plus 250 is what? 255. Violated. So you cannot have it. So you have to reduce the members, or else you will be penalized.
They already invested. They know they can reduce.
Before investing, you have to decide whether that many number of people I can appoint or not as a shareholder. Can I take money or not? So now this criteria is when, not after investing, you have to check. Before investing, you have to check. So when you invite the shareholders to invite in the company, you check whether how much is available, how much vacancy is available. It is as good as now you have the vacancy of only 200 employees. So you'll take only 200 employees now. Or will you appoint all the 300 and tell the 100 get out? Can you do that? No. So you'll check. Now tell me, guys. Total is how much? 5.
200, sir.
So 195 plus 5 is 200. 200, 250, 255. 255. No, it is 310, is it? 195 plus 5 is 200. 200, 25, 250. 255, no? Okay. Okay, now 195 plus 5 is how much? 200. 200 plus 250 and 5. 255 is correct. Now tell me, guys. This company is violated or not violated?
Not violated.
5 and 195. Exact 200. So not violated. Am I clear with this? Any difficulty in this step? So coming back to that point, which we discussed in the difference between a private company must have at least 2 members, minimum 2 members, but not more than 200. But not more than 200. Maximum is 200. When you count this 200, you have to exclude the present and past employee members. That is the present and past shareholders, employee shareholders. These people you have to eliminate. So can I say this we eliminated, this we eliminated, and director is also employee. We eliminated. Am I clear? So effectively, what are you left with? You're left with the pure shareholder. Pure shareholders who has invested the money only. They're not participating in management. They're not doing any work for the company. Pure investment. Only those people should be maximum 200. Am I clear or not clear? Am I clear or not clear?
Clear.
Yes. So I'll be
Yes, sir.
winding up. Just one more minute. I'll not take too much time. OPC, private limited company. Minimum shareholder in OPC is how much? Minimum shareholder in OPC is how much? OPC minimum shareholder. Shareholder OPC minimum.
One.
Maximum shareholder.
One, sir.
Minimum director.
One.
Maximum director.
15.
Private company minimum shareholder. Maximum.
200.
200 excluding present and past employee. Minimum director we have not studied. Maximum director we have not studied. We'll study next class. You want to know what it is? Minimum 2, maximum is 15. 2, 15. 15, 15 is same, but here it is 1, here it is 2. Clear with this point? Public company. Minimum is minimum shareholder. 7. Maximum.
7. Unlimited.
Director. Minimum 3. It is 1, 2, 3. Minimum is 1, 2, 3. 1, 2, 3, you know such song. Don't go beyond 3. But not more than 15. So if you see, in all the 3 cases, the upper limit for director is always 15. And minimum is 1, 2, 3. Shareholder is what? Clear with this? 1, 1, 2, 200, 7 unlimited. You'll remember this. I'm telling you guys this theory. Why I'm taking this slowly is because from your theory questions point of view, be it MCQ, be it assessment based questions, you will have a lot of weightage. That's why I'm taking so much time. If you get 1 or 2 questions from this segment, it's a big deal. Don't you agree? So for you to understand the concept, I'm taking it this slowly. Or else this entire theory I can take in 1 class and finish it. But you will not understand head and tail out of this. Am I clear or not clear? So please come revise for the next class. So I think in next 2 more classes, guys, we should be done with the theory. 2 more classes will be done with theory, and then we'll start with the practical questions. Am I clear? So next class we'll try and start sharp by 6:30, guys. Effective 2 hours if we give, we can complete it. So 6:30 next class, please kindly be in class. We'll start sharp. So with whoever is coming, whatever is the quantity of students, I'll start. Because only then in 2 classes I can complete the theory. Am I clear? Okay. Online people, any doubts so far?
No, sir.
No, sir.
No, sir.
So I hope you love the class. You got a lot of information, I suppose. I hope you guys enjoyed. So yes, with this, I put an end to today's session, guys. I'll see you all in the next class. Until then, bye-bye. See you. Take care.
Thank you, sir.
Thank you,
Thank
sir.
you.